Welcome to today's talk on tokenization of insurance contracts. So our speaker today is going to be Govind Shukla, who is an experienced insurance consultant with over 12 years of experience. He started his insurance journey by configuring monolithic insurance admin systems back in 2009. He's been involved in the blockchain space since 2016, publishing a paper supporting various proof of concepts and proposing new use cases. And that paper, Blockchain, a potential game changer for life insurance, was the #1 non-ad search result for the life insurance blockchain search from 2017 to 2019. Although Govind says that's probably a sign that not a lot of things were published on the subject during that time. Welcome, Govind. Over to you.
Thanks, Gordon. Thanks for the great welcome, and welcome everyone to this talk on tokenization of insurance contracts. Yeah, so basically today we're going to talk about the main core of the topic, that why are we talking about insurance, and why is tokenization, or the concept of, even, if we just come back from tokenization, about decentralization or blockchain in general, is relevant to insurance. And I think the most simple thing to think about is that if I ask the audience the question, do you understand insurance? Most people will say yes. And the most obvious things that will come up in their mind is the insurance that they pay for the cars, so the auto insurance or the home insurance or the life insurance. So at the basic concept, insurance is basically nothing but a contract to transfer a risk of something that might happen to you onto the insurer. So that is generally done by a contract that's called a policy that is purchased by the customer, sold by the insurer, and that covers the terms of a certain event or a trigger that can occur. And in the event of the trigger, a certain claim amount or that is basically a pre-agreed, or depending on the damage or the amount adjudicated by the insurer, has to be paid back to the customer. So it's a contract. It has multiple parties in it, and there are other third parties also involved. So as I said, it's not as simple as for example, if you want an auto insurance, you just go on a certain insurer, you already know about it, and you just go and buy insurance from them. It's generally a very more complex type of product, because you need to understand the product, you need to understand what type of product you need. So therefore, there are a lot of multiple parties, like, for example, brokers and agents, who help you understand what to in fact discover what need you have, and they help you prioritize what products work well for you. And again, they are not a direct party to the insurance contract that you have with the insurer, but they are part of the broader ecosystem, which means that the insurance company has a contract with these type of distribution brokers and agents to be able to provide those policies to you as a customer. There are other parties as well. Sometimes these policies are distributed on the aggregator websites. So the aggregator websites are like marketplaces where this demand is aggregated. They are also parties to the contract in terms of this contract of selling you the policy, but not part of the insurance contract. The whole point of, if you look at it from other point of view, now just to enable this interaction, the ability for an insurance company to take up a risk against you. So for example, let's assume that your household has 5-6 different people, right? All of them have their own cars, and then each and every person has an insurance policy. Similarly, if you just extrapolate this to a city, for example, there'll be loads of cars from different models and make, and different driving situations, different driving attitudes. A lot of this means that a lot of risk needs to be transferred to someone who can actually take the risks, in this case, the insurance company. And if you think about really simplifying it in terms of, if you simplify it, the insurance companies are people who aggregate the risk pool to identify if they are able to predict in the correct way that in the next year, how many people are likely to claim a certain amount of money from us, depending on their situation of driving attitudes, or their age, or the type and make of the model, and historical data on how the types of accidents that have happened in that area, or types of incidents that happen in that area. So all this information is used to predict and model and price the insurance that is then converted and sold in a policy to the customer. But for an insurance company, it's slightly more complex than that, because for being able to guarantee that, for in our example that we discussed in a city, if everybody's buying insurance policy, for them for be able to guarantee that if a lot of people have accidents, they should be able to pay out the claims to repair their cars all at the same time. There are certain financial requirements that they have to fulfill to be able to provide that insurance policy. So they need some kind of capital, almost like a guarantee that need to maintain a reserve for the amount of claims that might be claimed from them as a result of an accident or multiple accidents being caused on the roads. The whole journey involves people who are actually putting the money in, so they are taking a risk or against a lot of other events type of happening. So this is more common in terms of other types of risks like floods and more catastrophic risks, where there are products known as cat bonds that are sold out in the market, where investors bet on that event not happening, and the capital provision that they provide goes towards building that claim reserve. And if the claim reserve is not used, or the event doesn't happen, they definitely get the returns back from the amount that's not claimed. There are underwriters. Now, the job for underwriters is to make sure, as we were discussing a bit earlier, to make sure that the price of the insurance is right. That's an actuarial team that helps them do that. And the underwriting team makes sure that the specific risk posed by a certain car and a certain driver who's driving that car is actually within the bounds of insurability. And by insurability, we mean that from the knowledge, if, for example, we know that the person who's asking for the insurance for a car has already a lot of points on their driving license, they have already claimed a lot of insurance claims in the past, and the car they're using is not a newer model, it's a really old car which is prone to accidents. So these are situations which might deem the underwriter to say that this policy request is not fit for purpose, fit for insurance, and therefore they might deny them, provide them any insurance terms, or maybe provide them insurance terms with higher premium. Then there is claim assessment. So, for example, if somebody gets into an accident and there are two parties involved let's assume there are two parties involved in an accident. What happens is that both parties have third-party insurance, which means that they are covered for hitting someone, causing damage to somebody else, and the amount of damage caused by somebody else is assessed by a claim assessor. Now that's again a third party that assesses whether the damage is genuine and is it covered by the terms of policy, and the damage caused is covered off. So this is just to explain the ecosystem of insurance, which from our perspective, because we look at it from a customer point of view, sometimes it's not that visible. But if you talk about from a end-to-end value chain point of view, it's really deep and complex value chain with a lot of complex data moving about from different third parties to different third parties. Because of all this, there's a huge risk of fraud. This is data that literally is a big number from my perspective. It's just in the year of 2018, there were 1.2 billion pounds which were lost due to 98,000 fraudulent claims. Now, this number is the number where, given the technology and the practices and the regulation available in 2018, this was the number that we could track and we could identify. But there would definitely still be, given the stringent measures in place, there will still be more fraudulent claims that would have been paid in 2018, but we just don't know about it. So this problem is 1.2 billion is the number that we are aware of, and as a matter of fact, but the actual number might be even larger. The other thing that is very important in insurance is the transparency. So given the complexity, now the example that we discussed was about an auto insurance, but if you talk about a more commercial or insurance, which is, for example, somebody trying to get insurance for their restaurant operations, and in the restaurant operation, there's so many different types of risks that needs to be looked at, that is just too complex, for example, for a restaurant owner to understand and take care of each and every day or manage every day. So that's definitely one other type of risk that is hugely complex. And there are new technologies coming in, things like IoT sensors, cameras that keep on capturing the feed of information, and to make sure that the terms are always met and the risk is in control. So there's obviously risk mitigation part of the story, and also the second part of the story is claim adjudication when a claim happens. So what are the key patterns around trust and data exchange? Because the main concept that we're trying to bring out here is that there is value in talking about decentralization, blockchain, and tokenization. And the key benefit that we have is that if you look at it from this angle, we'll be able to identify if tokenization or blockchain or decentralization is a use case that can help insurance. So the first area to look at is trust. Every party insurance ecosystem trust on other parties. And this is basically because this is how it has been till now, right? So for example, if you look at the top 10 insurers in the world, all these insurers are insurers that had been in the business for hundreds of years. And a lot of this is brand value recognition. So the idea is that if you're buying insurance from a more reputed insurer whose brand name, whose company is the oldest, you generally tend to trust that you might get the best service. But it's not just in their control. It's actually one second, I need to actually take care of the Teams notification. Let me pause the share for a second and I'll take care of that. I'm assuming I'm audible now and my screen is visible. Yes, okay. So we're talking about trust. So the idea is that if we are just approaching a reputed insurance company who have very good ties and assume that that's the best case for us, it's not that easy. For every company, it's very difficult to make sure that they're able to provide you the best terms, and they're able to make sure that the scenario that you presented to them in terms of risk is insurable, and actually they have the right capacity to be able to match that. The other trend that we are seeing is concentration of businesses. So let's take, for example, we talked earlier about the brokers or the distribution channel of insurance. So in the broking space, if you look at the top three, four brokers, they are actually have the market share of around 50% of the market in certain lines of businesses, which is again a factor that shows that there is that factor of control of almost an expertise of being able to traverse through this complex environment, given the huge amount of experience these companies have and huge amount of economies of scale these companies have in these areas. Fraud, we just talked about fraud because there are lots of data that needs to be gathered. And so I'll talk about one more example over here, which is home insurance. So if you're insuring your home against, for example, flood, or if you're taking a home insurance against, just let's talk about fire or other catastrophes, what needs to happen in that case is that the assessment needs to happen where the risk of fire needs to be assessed from all points of views, from points of views of how many fire extinguishers do you have, how many fire avoidance measures do you have in your home, how many what things inside your house or a building is more prone to fire, and what are safety measures in place. Also, is your home near to areas which is prone to wildfires? There are loads of different parameters. Apologies, guys. Apologies. I was just facing some technical trouble. Okay, I'm back now. So the main point I was trying to make was that given the scenario, for example, the example of home insurance that we saw, just in one type of risk, we had to look at so many different data points from different data sources, and sometimes bringing it all together into a single model, and then making sure that all of that data is valid and is timestamped in the right way to make sure that we are able to prove that this was the data that was given to us on the basis of which the decision was made is essential in order to validate the overall value that's been derived from that data. I mean, in terms of trust, what we talk about trust is, and what we understand sometimes about trust is very different definitions. But in terms of literally the dictionary definition talks about reliance on the integrity, strength, and ability or surety of a person or a thing, that they provide the confidence or against a certain expectation, where they will be able to, deliver an obligation or responsibility when the expectation is set out to them. So the idea is that so as you can see in the insurance ecosystem, there's a lot of trust because, as I said, there are third-party data providers who we trust that they'll provide the right data at the right time. They'll be operational all the time when we need them to. There is trust placed on the brokers that they will broker the right terms. They will find the right policies for the customers, and they will be honest and they will be transparent with the customer to make sure that the customer gets the best outcomes. There is a lot of trust that the customer has on the insurer, that if they are paying the premium, they'll be getting the best service. Then there is trust or the insurer has on the underwriter to make sure that they're doing the best decision. Sometimes underwriting is outside the insurance organization, depending on certain types of lines of business. So that is, again, becomes a third-party trust relationship. Then you have a relationship or a trust that the insurer has on some third-party claim adjudicators. So, for example, if you had a home insurance and your home got damaged or there was a water leak, then a third-party claim adjudicator will come to your home and then assess the risk and then determine whether the risk was insurable or not, and then report it back to the insurer. So there is obviously that, again, a trust relationship. So what we see is that the whole insurance value chain is based on the concept of trust. And I've just looked at, and I was thinking, what is the best way to illustrate that as a more real example of what trust looks like. So I've taken this excerpt from an annual report of a major P&C insurer. They are the largest P&C insurers in the world. And what they're trying to say is that they have a certain kind of model in which, because the relationship that the customer doesn't have a direct relationship with the insurer, the customer has a more direct relationship with their brokers. So, for example, if you have a financial advisor, they advise you on different sorts of things relating to your financial matters, and they also tend to advise you on your, for example, insurance policies. And what happens is, if in case of a claim, the insurer adjudicates the claim and they pay the claim amount to the brokers. Now, it's broker responsibility to basically send that claim amount to you as a customer, because this is the nature of contractual relationship they have. So if you see here, there's already hoops that have been jumped in terms of trust. Now, here it is almost like a credit risk situation where if the broker fails to make the payment, then the insurer will remain liable for the payment that has never reached the customer. And this leads to litigation and all the other complexities, because at the moment, all this is happening through traditional finance, the way we do traditional accounting and traditional finance, and then we send the money out, we get the confirmation for it, and then that kind of route. At the moment, there are a lot of these kinds of risks or disclaimers that need to be called out, and a lot of regulation is also put into place to handle these types of credit risk scenarios and get them across. And just extrapolate that into a concept where if somebody's trying to buy insurance for like an entertainment venue, or where they are thinking about insuring a stadium or something, where there's so many risks and so many data points that at every point ensuring that these types of trust-based scenario doesn't occur, or make sure that we comply with regulations and everything is done by process, just the admin effort is so high that at the moment, the expense ratios, which is one of the important measures in the insurance industry to measure of the amount of premiums that was received, how much money was spent on on the expenses, on making sure that we are able to comply to regulation, we are able to do our day-to-day operations, pay our salaries, all that kind of piece of work. So you can just imagine that how much dependent we are on enforcing risk, and that how much investment that it takes for insurance companies and other people. So if you look at this was an insurer, and now look at a broker. Now, again, the broker is saying our business reputation could be harmed by our reliance on third-party providers. So this, again, is because the broking system is also complex. It is multi-layered as well. So a broker might be a broker who is an individual person advising to somebody else, who in turn might be reaching out to a larger wholesale broker to find the best outcomes for their customers. And the larger wholesale broker might be then reaching out to the insurer. So there is that tiered relationship where, again, there's a lot of trust in terms of reputation that the small broker is relying on the wholesale broker to provide the best outcomes or the best pricing. There's, again, always innovations and things that insurers do to sometimes go direct to the customers, and where the brokers then think that they are being disintermediated. So there are all those types of risks that happen. And also, as I said, this is just reiteration that brokers also rely on a large number of third parties to perform key functions for the business. So let's assume that a broker says that just to be able to provide a better quality of data to the insurer, so that the insurer, given that the broker is able to always provide additional information upfront, the insurer might be able to move fast on that case, and the broker might be able to get their commission payments quickly because the value is faster, and that they might be accessing a lot of third-party data themselves, or they might be doing some depending on some third-party vendors to fact find quickly. So those kinds of things as well is where the brokers are relying on the trust that the information provided them would be valid and correct. And all these problems that we discussed, where there can be lapse of trust, there can be situations where people might not comply to the expected agreement, and how that can be taken away. And this is why we're trying to make the case of why we are moving towards blockchain. I think if we are able to ensure trust by using an algorithmic method and make sure that all the data that's being provided. So let's assume the scenario of an insurance policy. So at the point when you're taking the policy, there were certain facts captured about your situation. So let's talk about an auto insurance, that your car is a certain make, it has been serviced at a certain point in time in the past, and you live in a certain area where there is a really low probability of burglary or theft. And depending on all this information, if this information is timestamped and is available in a system where you can trust that system to keep that information accurate, and also make sure that the facts that you provided are almost like sealed in time, and so that when the claim is made, now, similarly, at the point of claim as well, all the information that the claim adjuster has input also is kept on the same record. It can all be immutable, and what it can help in doing is really quickly identify patterns from that immutable record, and also prevent kinds of frauds where you might a person who has malicious intent might buy coverage from two insurance companies, and they would like to claim some bits of coverage from both, and all these kind of things can be prevented by using blockchain as a solution. Also, I would like to move ahead and talk about, I think this is just to talk about what values that blockchain can bring to the system, to the insurance that we're talking about. We proved that we have multiple parties involved in insurance. We proved that there are different systems involved in the end-to-end process. So there will be the brokers, the customer interacting with the broker systems, or the broker system then interacting with the insurer system, the insurer system interacting with third-party data providers, the regulator. In some complex risk scenarios, there might be multiple insurance companies who would be coming together to insure a certain risk. Then there's a concept of reinsurance, where, for example, the insurance company, because they cannot take on all that risk on themselves, they might choose to transfer some of the risk to the reinsurers. And the concept of reinsurance is nothing but if the insurance company wants to manage the risk by saying that can another insurer who specializes in reinsuring the risk portfolio of an insurer can take over some of the risk to them in exchange of a premium. That is also then brings the mechanism where the reinsurance systems also gets involved in this transaction. Now, just imagine the kind of multiplication of complexity at each point of trust that we're talking about, of data transfer, of making sure that you're able to dispose of the duties or promises that you're making to the other party. All of this requires collaboration, and there is lack of transparency. There is lack of transparency, not always deliberately, but sometimes because the data transfers across all these layers are already so complex that if we try to say we want to transfer 100% of data 100% of times, and the systems that are in place at the moment, a lot of the systems are legacy-based systems, which means that they don't have the capability of handling that kind of data load. So we need systems which can handle high volume transactions. We don't need manual intervention. We need as much automation as possible, and we want to be able to securely share information that sometimes is confidential, and there should be mechanism in place to be able to share data and make sure that that data is being used for a certain purpose and nothing else. And this is where I think disintermediation, transparency, reduce cycle times, all these benefits of blockchain are really important. So this is, I think, everybody must have seen some shape or form of this previously. This is basically just talking about different types of blockchain infrastructure that are available. And the reason why I brought this up is because I want to talk about what are the different kinds of implementations that people have been doing on and thinking about in this case. So public permissionless is more of a use case where people are thinking about this in terms of a blockchain which is available to the general public. And the biggest examples of this would be Bitcoin and Ethereum, where if you as an individual, you don't have to be a corporate entity, you can be a normal person and you can run a node. And what can happen, you can participate on the blockchain and you can do your normal activities of validating transactions and stake. If somebody's doing proof of stake, then stake your coins to validate transactions, and mine, in case of proof of work, mine transactions by having a node. This is open to all the people. The most ideal use case for this that has been discussed most these days is self-sovereign identity. So and self-sovereign identity is the concept where all the information regarding you, which can be your personal information, your driving license information, your credit related information, your bank details, a lot of information about you can be in your control by adding it to a public permissionless blockchain, which is it's not public permissionless, but it's more or less public permission blockchain, where you have the authority of giving somebody access to your information for a certain transaction. And that concept is important in insurance because, as I discussed, that for every insurance policy that's been sold, the first thing and there's a lot of regulation at the moment to make sure that the person who's buying insurance is not a fraudulent party, or they have not committed a fraud earlier, or they are creditworthy, and those kinds of questions where are need to be answered. So this kind of use case will definitely be helpful for insurance, but as it's obvious, it'll be helpful for a lot of different areas of business as well. Then we start moving towards the continuum towards more public permission. Now, public permission can be, very specific use cases where they're still open to public, but there is somebody who allows almost like access to that blockchain. So you have to get access to the chain, and all the data on the blockchain is not accessible to everyone, and it's depending on certain use cases, the access is disclosed according to the access privileges or rules decided on the blockchain. Then you have private permission. Now this is where you have set of very specific people coming together to form a blockchain. So let's talk about a use case where an insurance company, because they want to make sure that all their dealings with all their known parties, which they have contracts, they want to track all the transactions that are happening again with all the parties they are involved with onto a single network. That can be done on a private permission blockchain. And then people sometimes think about a pure private blockchain, but that's, at least in my view, there is no concept such that within a certain organization, if you have organization control within a certain organization, what you then talk about are more enterprise systems and not blockchains, because like any other data transfer technology like APIs or or databases can enable this use case. There are certain peculiar use cases where there are organizations that are so much spread out and they're under different regulations under different countries. If they want to ensure coherence and reporting quality, they might use some kind of private enterprise blockchain, but that's rarely seen. But we can see potentially more innovation in this area going forward. So you generally get two types of blockchains: logic optimized and transaction optimized. Logic optimized blockchains are, if you think about this in a really simple term, is that the Bitcoin is a transaction optimized blockchain, which is, it is good for making sure that the transactions are valid. The transaction is not a double spend transaction. It's where you're talking about transferring an asset from one person to the other. If there are multiple asset transfers in play, they're able to clear them out and make sure that everybody is able to understand who owes whom how much and is able to resolve that without there needing be a centralized authority. So that's an ideal use case for Bitcoin. The difference between Bitcoin and Ethereum, Cardano, is that Cardano, Ethereum are more projects which are logic optimized, which means that if you think about the consensus mechanism in Bitcoin, where you do the mining, the validation algorithm, the consensus that which version of the Bitcoin blockchain is the latest version, all that mechanism is built in as an algorithm onto the Bitcoin network, where the algorithm runs repeatedly to make sure that all the transactions are validated. The main innovation from Ethereum's point of view is that you can now control the logic, and you can define the logic yourself of what the consensus should be and what logic you might want to build on top of that mechanism that's been put together. And that brings the concept of smart contracts, which is basically nothing but being able to define, once you have the basic benefits of a blockchain, things like immutability, things like the latest version of truth validated by the majority consensus. Once you have these building blocks, you can decide what rules you want to validate or what types of conditions you want to put into the blockchain for triggering certain events. So we'll talk about that a bit later on as well. Okay, I just want to give a quick pause here. Gordon, do you see any questions?
We have got a few questions. The main two that we've got are basically asking for examples. So we've got, what real world examples can explain tokenized insurance contracts and what competitive benefits did they bring? And a very similar question, can you please give us some examples of production blockchain implementations for insurance?
Brilliant. I think both the questions are great questions, and quite interestingly, we are on the right slide that talk about both these concepts. So tokenizations, and also talk about the production version of these things as well. So let's just for a second answer that question, and then I'll jump back to the thing. So tokenization in the real world, the issues that we were discussing earlier were around how do we ensure that there is skin in the game. And skin in the game is a concept introduced by Nassim Nicholas Taleb, and his point of view is that if any party in a transaction or an interaction doesn't have skin in the game, then we can't expect them to be 100% committed to that contract. And this is the concept that companies like Nexus Mutual, for example, are well known to introduce. So Nexus Mutual have brought together, have provided a solution where not just where they're tokenizing multiple different things. So one of the first things that they're tokenizing is the ability to invest capital into the insurance company. So one of the solutions they are providing is they are providing insurance against your crypto wallets being hacked, for example. And what they're doing is that, as I discussed earlier, for an insurance company to be able to provide an insurance policy to you, they have to have some reserves to be able to guarantee that in case of a claim event, in terms of the wallet, let's talk about a hack that can happen on the wallet. In case of that, they should be able to have enough money to be able to pay back the insurance claims to you. Now, for that, what they've done is they've created a token, which is, I'll just do a bit of a skip and I'll come back. I think it'll be helpful in the broader piece as well. So this can be a risk pool token, which can be a token which people can buy in. And this token is called NXM from their point of view. They can buy in as a financial derivative, where depending on the performance of the blockchain, if not a lot of hacks happen, the people who invest that token get the value back. That's a pure, a very similar concept to that I talked about earlier is catastrophic bonds. So if you invest into this kind of policy, let's talk about Nexus Mutual, you buy that token, you're investing into the concept saying that you're going to assume that not a lot of claims are going to happen this year. And if that's the case, then what happens is there is definitely leftover capital, which is, so let's talk about more practical examples. Let's assume that there is just a hypothetical scenario. There is a total of 10,000 NXMs invested in a certain type of risk. In that year, there was just 1,000 NXM worth of claims paid out. Now you still have 9,000 pounds worth, 9,000 coins, 9,000 NXMs worth of claim that was not claimed back, which means that 9,000 was invested into a certain vehicle, and it was kept there or invested in a certain vehicle or used in certain other transactions. It would have gained in value, and that value is then can be returned back to the investors. So that is one example of a token. Then you can have other tokens where you can have tokens that talk about risk classes, where you might say that I guarantee that I want to invest. Yeah, you can then choose that, instead of just going to a generic all portfolio, you might choose that I am going to I'm going to get a token for just investing in a certain category of risk. So you can have more specific tokens around that. Then you can have other use cases around that. You can have staking. So you can say that I am a claim validator. I want to stake my tokens to make sure that, to validate a certain claim being valid or not. Now that can be multiple mechanisms for that. So you don't need to be a specialist to do that. But if there are certain images and you have access to expertise on your side, where you can say you can validate images to make sure that they're not tampered with or they are accurate or sequence, or there can be algorithms that might run on your system that might validate certain sequence of transactions or check for tampering. So you can stake your tokens to make sure to basically almost bet by information on the fact that the claim that has been submitted is valid, and that staking can get you benefits. So we'll talk about these concepts later on, and this is a live blockchain that's in production at the moment. You can go check out Nexus Mutual. They're really cool. The other one I would suggest you to check out is EtherRisk. They are providing different, they are a marketplace again. They are a marketplace for providing different types of risks. Now, Nexus Mutual at the moment is just focused on crypto related risks, but EtherRisk have partnered with a lot of real world companies, things like flight insurance, supply chain insurance, marine insurance, different types of use cases where the core benefit that they bring in is obviously the benefit of being able to invest in the risk of the platform, but also the other things that we talked about in terms of staking and other benefits. So these
just
are
a quick time check, Govind. We've only got about 3 minutes left.
All right, okay.
And that was including Q&A time. So obviously we've weaved the questions in, but just to let you know, we've only got a few minutes left.
Yeah, okay. So I mean, the main point is that what we are seeing is, the questions really help to build the main point, is that we will see movement towards more skin in the game, where people will have more specific control of the risk they want to invest in from an investor point of view, but also people who are experts in terms of who can underwrite claims, or who can underwrite policies or can adjudicate claims, can have exclusive control, and they can stake tokens to get these kind of decisions made. On the other side, what's happening is there are consortiums that are going on in the market, and they are actually talking about bringing in a lot of innovative use cases that take away the concept of trust from not the whole value chain. So insurance companies doesn't have to throw away all their systems. They can still have all their systems, but they provide a layer of a decentralized layer of cross-party validation of transactions. So things like making sure that if a person comes to you, have they committed a fraud in the past? Yes, no. That kind of questions can be answered on these kinds of platforms. Or yeah, there are other use cases built on top of it, but that is a different type of layer where you don't have to use that whole stack as your insurance system, but rather you can integrate with that. Okay, so I mean, I'm gonna then shift to this slide. I think this is an important one. So this is where I was talking about. So you have the risk pool token, where you basically say that I want to focus on certain kind of risks where I have expertise in understanding hurricane patterns, or I trust somebody who is an expert in hurricane tracking, and they are saying that this risk assessment is correct, and they think that the risk for this kind of hurricane to happen is low. I can stake my tokens with them, and then get the benefit if they are actually right, and we trust their expertise, or we are the experts ourselves, and we say that this will not happen. This kind of staking will help make sure that that risk doesn't happen, and that staking will give us the benefit. The other type of concept can be just the simple platform token. Now the platform token is more like the usage based token, which means the volume of transactions that happen on the platform, certain kind of claims can be paid or received, or the accounting can happen on that using that platform token. This is more like a pure other platform tokens, like you can think of this as more like an Ethereum based token. The other one is consensus, which is very important. This is the general decentralized autonomous organization concept, where the important thing is that at the moment, because there are multiple parties involved in the insurance value chain, so the insurer, broker, third parties, claim validators, all need to come together and agree on a certain terms to apply a certain kind of governance principles around the policy. All this can be done in a decentralized fashion. And again, people can stake on a certain decision being right and use their stakes to make sure that the decision is decentralized enough to take care of all the parties involved in a certain transaction. So this basically just gives us a glimpse into what's possible in the future with these tokens coming into play. And yeah, I'm sure, I mean, we did not have enough time to cover a lot of other content that I had, but what I'm going to leave you with is that tokenizations ensure skin in the game, which is not the case at the moment. It reduces the requirement of regulation, and complex reporting, which requires a lot of investment, a lot of human capital, and a lot of time. That will all go away if we are able to move towards pure tokenization of risks, tokenization of being able to stake yourself, and being able to say that agree on consensus on certain kind of governance principles. I think that's me speaking.
Yeah. All right. That's lovely. Well, thanks very much for that, Govind. That's been a lot of information for us, and I'm sure people that are interested in it would be good to follow up with you afterwards and continue the conversation. But you say it's great to see that decentralization and a trust-based network or trustless network.
Yeah.
All right.
Absolutely.
Thanks very much for your time, Govind. Thanks for all the participants that joined us. Thanks for the questions that we had, and we look forward to seeing you on the next session.
Thanks for having me, guys. Bye.